Hi, everybody, and welcome to the Sphere Home Loans Investment Lending webinar. I'm just going to wait for a few moments. I've got a few people logging in. I'm just going to give them 2 minutes to log in before we start. I'd like to begin by acknowledging the traditional owners of the land in which we meet today. I'd also like to pay my respects to the elders, both past and present. So welcome, everybody. We have a packed agenda for you tonight. Investment lending. I have our investment specialist, Carroll from our team here today.
Hello, everyone.
Thank you for joining us.
No worries.
We are going to grill him about all things investment lending.
Yeah.
I would like to thank everybody for sending their questions in beforehand. Gave us a really good gauge about what you would like to know. I think the best way to answer a lot of your questions is going to be by going through some scenarios. So we've got a few scenarios prepared, and I'm going to go in like a client and ask Joe all the questions that you would be asking. And because we've only got about, I think about 50 people to 80 people have registered for tonight. So it's probably small enough to ask questions as we go. So after each scenario, we're going to stop, ask all of your questions, and then we're going to have time for other questions right at the end. I'm going to try to answer as many of the ones that you've sent through while we go along. So just to kick us off, we've got a basic scenario here. It is, I'm a client, I've got a house worth $1 million, I've got a home loan of $500,000, and I want an appointment with a mortgage broker to say, tell me what I need to do to buy my first investment property. This is a really common scenario that we get. And a lot of people ask a lot of questions about, can I use the equity? Do I need a cash deposit? How do I go about the first steps? So Joe, tell me what we do the first steps.
Well, the first thing we need to do is we need to establish how much equity we've actually got in your existing property, right? So, and that's through the process of ordering valuations with a variety of different lenders, and those valuations may actually dictate which lender we go to. But let's say in this example, we've already done that. We've got valuations on file and they've come in at $1 million. You only owe $500,000, which means that we've got approximately $300,000 worth of usable equity. Now, what I call usable equity is up to an 80% lend. So you're only borrowing up to 80% of the value of the home. And the reason why we look to do that is we can avoid paying lenders mortgage insurance there and also avoid those higher interest rates.
But I could go to more if I wanted to.
Absolutely. And, especially if you're in a profession whereby you're in the medical profession, a doctor, dentist, or something like that, or even some legal professions as well, you can get that LMI waiver. But for simplicity's sake, let's say, for example, we're just going to go up to a maximum of that 80% lend. So we've established there's more than sufficient equity there for us to do that.
So I've got a mortgage worth $500,000. I have usable equity of $300,000. So that's definitely enough for me to buy an investment property.
Absolutely. Yeah, absolutely.
So let's pop on. I've gone and had a chat to somebody. I know what I want to buy now. I want to buy around for $500,000. I've spoken to somebody. I know that I'm going to get a good rental return for this property. Tell me how you would start to structure my lending and why.
So this is really important. Structure when it comes to investment lending and building your property portfolio is incredibly important because you want to set yourself up for success right from the beginning. So in this diagram here, you'll see you've got your owner-occupied home loan of $500,000. And then underneath that, you've got a separate investment split of $125,000. Now, for the mathematicians in the room, you'll see that that is 20% of the purchase price plus any associated costs with purchasing, which would be stamp duty, legal fees, possibly even a buyer's agent fee if that's the route you've gone down. So let's just say, for example, we're buying for $500,000 here. We've taken a 20% plus cost split. It's secured against your owner-occupied debt, but this is really important. It's still classified as investment debt. So when it comes to tax time, we're talking about tax-deductible debt, it's still classified as investment, and that's really important.
So why wouldn't I do a loan just for $525,000? I need $525,000 to buy this house. Tell me again why you split it.
I've split it. So obviously you've got the 125 there secured against the owner occupied, and then you've got the remainder of the 80% underneath, which is the 400,000. The reason that I've split it is because this is the most fortuitous way and the safest way for you to build your property portfolio. So let's say, for example, we were looking at this property here and we want to buy for 500,000. but we want to keep it separate from your owner occupied. Down the line, you might want to sell that owner occupied, or you might want to build a bigger investment portfolio with multiple properties. If you don't separate it like this with this structure, it becomes quite difficult to sell your owner occupied, but also you're becoming quite dependent on all the valuations coming in at a certain amount to enable you to build that portfolio moving forward. So that's why we separate it. We separate it and we give you that little degree of safety as well.
So other than the equity, so I've got the equity here. I clearly have enough equity to do this. What else do I need to show the bank I can do?
Servicing. So servicing is your ability to make repayments based off the income that's you're basically getting, right? Whether that be through your job or indeed the rental income from the prospective investment property that you're purchasing. And that's important to note. Some people don't realize you can use what you're prospectively going to earn from the investment property. However, you can only use 80% of it in most cases of that rental income. So that's really important. Servicing is how much you've got coming in relative to what's going to be going out.
Yeah, great. So on this same scenario, it's probably important for us to start to talk about the repayments. So how much is this actually going to cost me? So I can do this equity-wise, but how do I do it with my income, and can I afford to do that? So I've gone to speak to somebody about this property. They told me that it's going to rent for about $500 a week.
Yeah.
That's $26,000 a year, $2,100 a month. But he said only to use 80% of the rental income because I'm going to have costs.
Mm-hmm.
So that means from this property, I'm expecting to net about $1,730 a month. Tell me about how much I have to pay for these loans.
So if you look here, I mean, we've given you an example down here at the bottom. If you're earning 1,700, even if we do interest only, which is a lower repayment than principal and interest because you're not paying the loan down, it's still going to cost you $2,850 a month. So I have two very separate conversations when I speak to any client with any home loan, whether it be investment or owner occupied. There's what I can make happen and what the banks will lend you. And then there's what you feel comfortable with, because what that doesn't take into account is what your long-term goals are. And when I talk about that, I'm talking about possible lifestyle changes, whether that be children or a career change or whatever it might be that you've got lined up. So you need to be comfortable with those repayments and those repayments moving forward before you decide to take this on. That's a big commitment. That's $1,000 of your own money going in to pay off this additional mortgage.
So if I could afford to pay principal and interest, and that's something I would like to do, would you set it up principal and interest?
So again, it all depends on what your long-term goals are. It's my opinion that if we're looking at an investment property and you've got owner-occupied debt, your number one goal, which sounds crazy coming from a mortgage broker, but your number one goal is to be mortgage-free on that owner-occupied. We don't want owner-occupied debt, the $500,000.
So this is my mortgage. This is the one I want to pay down.
That's the one you want to get rid of, right? So my opinion would be, even if you can afford the principal and interest repayments and you've got that extra cash flow each week, fortnight, month, why would you not redirect that towards paying off a debt that's not tax deductible? The investment debt is tax deductible. The owner occupied debt is not tax deductible. So if you've got additional income that's available that you think you could pay P&I, move that over and pay your home loan off. Get rid of your owner occupied home loan. That would be my recommendation.
So my home loan's still $500,000.
Mm-hmm.
Now let's say I have $100,000 saved, and I want to put that into the investment to lower my repayments. These repayments I'm going to struggle with. I've got $100,000. I want to put $100,000 into this to reduce these repayments. Tell me what I should do.
If I've got $100,000 extra lying around, I would be putting that into my owner occupied offset account. So if I've got an owner, or even reducing my owner occupied debt, because again, we're moving back to the same old discussion of tax deductible debt. If it's an investment debt, it's tax deductible and therefore is advantageous to you. Whereas that owner-occupied debt is not tax deductible. So why would you not try and reduce that down as much as you can, as quickly as you can? And like I said, even if you put it in your offset account, you're not paying interest on $100,000 worth of debt. So that's where I would put it.
But if I wanted to reduce those repayments,
I would reduce the actual limit itself down to 400,000. Yeah, to give you that flexibility.
And how do I do that? How do I reduce my repayments? If I put the 100,000, do my repayments automatically reduce?
A lot of the time you have to call the bank. It's really funny. I actually had this scenario with a client today.
Did you?
Yeah, because he was like, I don't understand why my repayments haven't gone down. I was like, okay, we need to actually do something. They're not just going to do it for you. So, and we spoke to the bank and said, look, we've actually reduced the limit down. Can we please have an adjustment on the repayments? And then that's taken effect today.
Yeah.
Mm.
Or you could not reduce it
Or you could not reduce it and purely
pay the principal off
and pay
at a
as
quicker
quickly
rate.
as you can. Yeah, exactly right. Yeah.
But I think it's really important to note that this is your home loan and everything that you have focused on is reducing this. Holding this when rates were 3% was a lot different. So when rates were 3%, and a lot of people talk about, it was only 18 months ago that you could have held this property and the repayments would have been $1,300 a month to hold that property. So that would have been a cash positive property. And there's a lot of questions here about positive or negative geared. I haven't seen a positively geared property since the rates have gone up over 5%.
You're going to be hard to find one at the moment because of those dramatic increases in interest rate. It's going to be very difficult for you to find a property that is going to be positively geared purely from its rental income. To be positively geared now you need a massive deposit to reduce that amount of debt and therefore reduce the operating costs of that investment.
Yeah.
So it's very rare that we would see that.
Yeah. But again, this one here is what we're trying to get rid of. So all our focus goes on to this. These two are tax deductible. And when you go to your accountant at the end of the year, these are the two that I'm saying is for this property here, even though this one is secured against this one.
It doesn't matter what it's secured against. It's about its purpose. It's all about the purpose.
Yeah, great. So before we move on, and we've got another more complex scenario, has anyone got any questions just about this basic concept of using equity in your home to purchase another property? If you've got any questions, please let us know. But that's just the basics of being able to, I'm just going to check if we've answered this one. So someone's asked the question here of is negatively geared property a really smart investment when wanting to start a portfolio? How would you answer that question from Anna?
Is negative gearing really a smart investment when looking to start a portfolio? Well, I think, honestly, at the moment, it would be difficult for you to find an investment property that's not negatively geared. So the thing that you've got to remember is don't overcomplicate it. Remember, this is an investment. That's exactly what it is, right? You're investing your money and your income into something that's hopefully going to build wealth for you. So yes, absolutely, it's still a smart investment at that time. But if you were going to only invest in something that was positively geared, you're going to be very hard set to find anything like that. And remember as well, there's two different considerations when you're talking about investments. You're talking about yield, which is how much you're getting in relative to how much it's costing. And then there's capital growth, which is what a lot of people focus on. They invest in property to see that capital growth and then use that money moving forward to build their wealth.
So I can't see, there's one question here. I'm just not coming off my screen. I just didn't have the screen open. That's why I couldn't see it. There's a question here that says, how soon can you access your equity from the owner-occupied property? We just got our first home. It's a unit off the plan, and it's already gone up in value compared to when we signed the contract. That's a really good question, Anna, and I think that you would see this all the time, Joe.
100%. Let's go. Let's do it. Call us tomorrow. No, I'm kidding. Yeah, straight away. Like what we do, it's all dictated by the valuation. Okay, the valuation is the marker of how much equity you've got. So let's say, for example, if you've got a property and you've bought it off the plan, and by the time it's finished, as is with many cases, those developments are worth significantly more than what you originally paid for them. I do a lot of these. We would simply get a valuation on that property right away, and we might order a valuation with a variety of different banks to get a few and see where it's sitting. And if there's sufficient equity to go, we would go right away. There's nothing holding you back from that.
Yes, there's no minimum amount in time. We've got another question that's just come up that says, what if you own your owner occupied but have no deposit? And that's a great question. I'm going to flick back on these slides. No, I'm not. It's not going to let me do that. Yeah. See this scenario here. If you have no home loan here and you've got a house worth something, you would just get the investment split against your home. The fact you've got no home loan is just working in your advantage. You would not have a home loan at all. You would just have this investment split here. You would have an investment split secured against your unencumbered home, and then you would buy an investment property. The only difference would be if you didn't have a home loan at all, you didn't have this, you may have offset accounts linked to your investment loan because you'd want to be using your cash somewhere, because we always talk about this goal of getting rid of this home loan. Well, you've already done that. You've already gotten rid of this home loan. You would probably sit all of your savings in an offset account against your investment property, which you would only do if you had no home loan. So I hope that answers that one. With no other questions, I'm going to pop on to this next scenario. So this is a really common thing that would happen. It's actually the same scenario as before, but we're just going 5 years down the track. So I'm coming to Joe. I've still got my owner occupied. It's worth $1.5 million now. I've paid my home loan down to $300,000. Well done me. That's been a great 5 years. I've used all Joe's advice and put all the P&I repayments straight into this home loan. I still owe $525 for my investment property that I bought, but it's gone up. It's now worth $820,000. Now, this is one loan now, not two. How did you make that happen, Joe?
So what we've done here, because there's now sufficient equity in the first investment that we purchased, I've moved the entirety of that debt, so the 125 plus the initial 400 that we had secured against it, over to it and put it as one loan. And we can only do that because there is sufficient equity in that first investment to do so. So that's what we've done there. We've moved it away from the owner occupied and we put it straight onto the investment. Now you'll see here, we've rinsed and repeat, right? We've got an additional $125,000, which is the 20% plus cost deposit for the second investment. And then the remaining 80% secured against that investment, which is the 400. So we are literally rinse and repeating, going straight on to the next one, but using investment equity that we have built to help secure the second investment.
So if I didn't want to buy investment two, which means this loan and this loan wouldn't exist, would you still have done this? Would you have still pulled these into one loan?
Absolutely, yeah. I would have moved it over so it's secured against that one property, just to give you that degree of separation. And that could be for a variety of reasons. You might say that you want to upsize your existing owner occupied, or you might want to sell it. If I can secure the entirety of the investment debt against the one security, then I will. Absolutely.
Yeah. So you would have a lot of clients, Joe, that are building their portfolios now. Tell me why you set them up this way and what their goals might be down the track.
So the reason being that there's two basic structures when we're looking at investment properties. There's cross securitization and then there's uncross, which is what we're recommending here. And it's what I always recommend when it comes to building an investment portfolio. And the reasons are twofold. One, it provides you with more security by not having your owner occupied tied up with investments, because you might have a plan of what you want to do moving through the years, but that plan can change. And if you want to do something like sell your owner occupied, you need the flexibility and fluidity to do so. The second reason is that if we're building a portfolio gradually up over time, if we've cross securitized them, I need all of those valuations to come in at a certain amount to enable me to do what we need to do to build that portfolio. Whereas if they're uncrossed, I'm not reliant upon that. So it doesn't give us that rigidity, like to do what we need to do.
So this little line here is like a firewall between these. And so this is one loan secured against just one house.
Yeah.
This is a firewall. This investment property has these two loans and a firewall. So this could be with different banks, or it could be with the same bank, as long as they don't have a clause that lets them have all money. So a lot of the banks that we would use for investors say that if everything's separated, they can't call upon any other loans. So it's called an all monies clause. We just need to make sure there's not one of those before we do it, but you can leave them all with the same bank as long as you create a firewall between each application and each security. Now, my portfolio is probably a little bit different to Joe's.
Yeah.
I've got clients that I've had for over a decade. They've been building portfolios all of that time, and they've built while rates have been quite low. And now a lot of them are looking at downsizing. A lot of them are thinking, well, we're well into our 50s now. We've built these great portfolios, but I've seen a financial planner and I'm looking to downsize one. These high rates aren't really working for me right now. I'm going to offload one. I'm going to stick that money into super. Now, having set people up like this is not just really important on the growth phase, but it's really important on the downsize phase. And I'll give you an example of this. I have two clients that had really good income. They were both a husband and wife, really solid incomes while they were building these investment portfolios. Now, he's already retired. He's decided that they're in a position where he doesn't need to work. He's on the golf course. She's still working on a really good income. But when I go to the bank and show them all of these loans, they don't service those loans on paper anymore. So they want to sell one of their investment properties. Let's say it's this one here, and they want to use the cash from that sale. So they're going to, they're going to get, $300,000 from this one. They want to put that into super. If I have these two things crossed, the bank would do an assessment of all of their lending. They have every right to do that, and they do. And they would say, well, now you've only got the one income, you can't afford this home loan, we're going to make you pay that out. But that wasn't what they had planned for those funds. They had other things planned. So keeping these things set up correctly isn't just important on the way in, it's really important on the way out. Every decision that gets made for each of these properties, we're creating a silo. And I'm just seeing a question come up that says, from Janelle, saying, do you stick with the same lender? It's up to you completely. Now, I personally, for my personal portfolio, I stick with the same lender. I love cheap rates. So I will have all of this set up with one lender, and I'm going to go to them. I'm going to say, I want the best rate because I've got a lot of lending and I want the simplicity of it all on one app. And that's what works for me. But we have a lot of clients that you would use a different lender for each one of these.
Yeah. And I think it's important to note that when we're talking about pricing with banks and interest rates, they do tend to price more aggressively or give you a better interest rate on aggregate borrowing. So if all your lending is in one place and over a certain threshold, they do tend to give you a more aggressive rate, which is great. In terms of, do you stick with the same lender for the life of the loan? Not necessarily. We might establish a structure with a specific bank and they're giving you a very aggressive rate at that time. And then 5 years down the line, it might be that an alternative lender is a better option for you. And if it's fortuitous to move you, then that's absolutely something we would explore. I personally have no lender loyalty whatsoever. So if it's the best rate and the right structure and in the best interest of you as the client, then I will absolutely move you. Yeah.
And sometimes we're putting people with a bank for a policy reason. We had a client this week that was a director of a company, and he drew a really big salary, but his financials were complicated. There were a number of business partners. There's a lot of stuff going on in the companies, and we really didn't want to give those company tax returns. We used a bank policy that would allow us to use just a pay slip for the director of the company. It's a great policy, but for that reason, that dictated that we put all of these properties with that same lender, because we weren't going to a lender for a particular reason other than policy. We couldn't have split it up because the other banks would have made that lending more complicated. I think it's really important to note that as mortgage brokers, we probably spend 80% of our time doing this for clients rather than looking at lender comparisons. I think people think we sit at computers and look at different rates of banks. We spend 80% of our time breaking down scenarios for clients, of people coming to us and saying, here's our scenario, this is what we're doing, this is what we want to do. Can we do this? How would it look if we use scenario A, B, and C? And can you break that down for us? And we do all of these up for them, and they have the information then to make an informed decision. We're not sort of picking a lender at this point. We're just breaking down scenarios. And then when you know what scenario you're doing, that's when we hit the banks and go, well, who's going to price this up the best? Someone's asked here, how much does it cost to get a bank valuation? And if it's expensive, how can I get the most accurate valuation of property? Joe?
It doesn't cost anything. If you're dealing with the right mortgage broker, you can order a valuation most time and we can have the valuation fee waived. So it shouldn't cost you anything. What we tend to do is order a lot of valuations up front because we need to establish that equity position before we even decide what we're going to do. And we might order a variety of lenders because sometimes valuations differ. I had one that came in $200,000 different from one bank to the other. That was last month. So they can vary bank to bank. There are some lenders that will go off what's called an AVM or an internet valuation, and they can sometimes be at a more fortuitous value than if we were to do a full valuation. So that's a discussion that you would have and you would go through, but it shouldn't cost you anything. It shouldn't cost you anything.
Yeah. And Kat's asked, if you haven't set it up correctly from the get-go, how long should you wait before making a change? That's a really good question too, because a lot of people do set it up incorrectly at the start. I would say if you haven't set it up correctly at the start and you're in an income position and an equity position to make a change without cost to you, you would go ahead and do it now. But sometimes you're still in mortgage insurance territory and it would be a cost. So you'd wait until the valuation was sufficient to allow you to do it, or you would, income-wise, you might need to wait. So I would always go to a broker and say, can I do it? What would it cost me? Get the scenario. It doesn't cost anything to break that down and make a move from there.
Don't panic though. It's okay. Like all of this is is flexible and we can adapt to a changing situation. So it's not the end of the world. It's fixable, and it's just a process that you would go through, and just making sure that it's fortuitous for you at that time.
Yeah, so there's been a few questions as well about, and a lot of questions, I would say, because people do want a lot of things at the same time. And there's a lot of questions that we got in the pre-questions about, what if I want to upsize my owner-occupied home? Tell me about what building my portfolio is going to do to that. A lot of people are, building this portfolio while they're young and single, but when they have a family, they want to upsize their owner-occupied home. Tell me you've set me up correctly equity-wise, Joe. But what do I have to do if I want to upsize this owner-occupied? It's worth $1.5 million now, and I want to buy a house worth $2 million. Have I impacted myself negatively by buying these investment properties?
Yeah, so you've got to remember, whenever you've got debt, whether it's owner-occupied debt or investment debt, any debt that you hold is going to be detrimental to your borrowing capacity. So we have to bear that in mind. Let's say, for example, here we've got 300,000 we wanted to buy for, I don't know, 2.5, and we ended up wanting an $800,000 owner-occupied home loan. You've got to consider you've also got over $1 million worth of investment debt over here. So this is where it all comes down to the broker and running scenarios. So I would run the scenario. I go, right, okay, let's have a look. Do we have serviceability? We're going to have enough equity from the sale of the 1.5 property. Do we have enough serviceability to be able to service this additional debt on top of the investment debt that we've got? Yes, we have. Great. Let's move on and let's get a pre-approval in place. Or if not, that's when we have another discussion, and that's about whether or not we want to sell one of the investments.
So just to clarify, you've broken this up here. So I've got these walls in between these applications.
Yeah. You've
separated all this equity here. But if I want to upsize this home from $300,000 to $800,000, I don't just have to service the $800,000. Even though these are separate, I need to afford all of these loans at the same time.
You've still got to be able to afford to pay for that additional investment debt, or indeed any debt that you hold at that time.
Okay, so that could hold me up.
Absolutely. And at the moment, it's holding a lot of people up. With larger investment property portfolios, it has become quite difficult for you to service additional debt, because not only have the rates gone up, but with the rates going up, the assessment rates have also gone up. So for any home loan that you've got, let's say your interest rate is 6.19 on an investment debt, the banks are going to assess that at 3% above that point, so 9.19. And what that does is it has a dramatic effect on your serviceability, because it's reducing the amount that you can borrow. So that is constantly a consideration that we have at the moment. We have clients that, 18 months, 2 years ago might have been able to borrow significantly more, but that position has changed now.
I think it's really important to note that the people who built portfolios, and clients that built portfolios with me 10 years ago, the landscape was different in lending, even when rates were higher. So a lot of people, rates were still this high, or 5% 10 years ago. It wasn't about the rate, it was about the lending assessment rates. So back when I had clients buying multiple investment properties and they could afford 5, 6, 7 properties, the bank's assessments were different. They didn't just they looked at actual repayment. So if you're paying interest only on all of these loans, the banks only looked at those repayments. So, you're paying $400 a week in interest. They're saying, well, there's $400 a week of your income. But now they're looking at not just the 400, they're looking at the principal and interest, they're looking at 3% higher. So even though this property might be covering itself for you every day, the bank wants to see another 20 grand in income for a property that looks just like this. So you have to have a very big income to be able to set up even 2 investment properties, let alone 3 or 4. I don't think 70% of clients in my portfolio would be able to grow the portfolios they had the guidelines be here now.
Yeah, not to mention, dramatic increase in living expenses. Obviously, just the affordability of property in general has increased significantly as well, like the value of property and how much it's costing to purchase them. So to build those sorts of portfolio has become quite difficult, and you do need a larger income once you get into those 6 or 7.
And I see that a lot of people on this webinar right now, you're not watching a webinar at 7 o'clock at night if you're not interested in investing. And people do want to do it as quickly as they can. But I think the guidelines now are really going to slow you up. So it is going to be about this scenario is probably a really valid one, which is it might be 5 years between your investment properties. You might have these sorts of equity rises. You might need to wait for this home loan to go down before you get your next one. But I still think you set this portfolio up like it's going to progress, whether it's quickly or slowly that you build that
Doesn't
portfolio.
matter. You're still building your wealth and building your financial future. Like, there is a bit of a tendency for us to put a bit of pressure on ourselves, especially to try and build that portfolio quickly, but make sure you're doing it the right way and make sure that you're doing it with the right structure. That's the main thing that I would take.
So I'm just going to answer one more question before we move on to rent vesting. Anna's asked, how often should one consider to shop around for better interest rates from lenders?
Look, I think it's always valid to ask the question, because if you don't ask, you don't get. So, I'd be talking to my lender as often as every 2 to 3 months to see if they can reprice my home loan and get it on the most aggressive rate possible. What I wouldn't recommend is refinancing repeatedly over and over again, because it's going to have eventually a detrimental effect to your credit score. Always ask the question though, because unfortunately, banks are not just going to hand out repricing and a lower interest rate to you unless you ask. We have someone that works full time in this office, and that is their sole job, is to ensure our clients are on the best rate possible at all times. So we're always contacting the bank, asking for a better rate, and so on and so forth. So ask the question, certainly, but I wouldn't be refinancing in quick succession.
I don't think a lot of the time you don't need to refinance. I think there's this common misconception that you need to refinance for a better rate. Most of the time we're going and reviewing our clients' lending and repricing it with the bank that they're with. Sometimes there's a reason to refinance, and we can absolutely give you the options both ways. Yeah. But I would say we would be, when we're doing our reviews, and we do them more commonly now because we're doing them at most rate rises, which there has been a few, we are looking at saying, here's the best rate we can get from the bank that you're with, and here's the next best offer in the market. It's your choice. And a lot of the time what we can get with the existing lender is really close. So don't think that you need to refinance. Repricing is the big word. So another question here is, my own occupied is almost mortgage free. However, it hasn't gone up much in value. So it hasn't gone up. I now decided I want to move away and either rent or buy a new upsizer. I'm worried about missing out on property growth in the area I currently own. How could I go about turning my current property into an investment property? Now, that's a really tough one, because your house, so let's just say your house here is nearly mortgage free. So let's use this as a scenario because it's very close to, what this could be. Now, a lot of people look at this house and go, well, there's a $300,000 mortgage on a $1.5 million property. This is really going to cover itself. When I go and buy my $2 million house, I want to upsize, I'm just going to keep this one as an investment property because it covers itself. The issue with that is, if you sell this property to buy the next one, you're going to get, $1.2 million out for the next house. So yes, while this one would cover itself, you wouldn't be able to get the $1.2 million out. So if you go and buy a $2 million house, you're going to have a $2 million mortgage. And the payments on that would be a lot more than if you sold that house, took the 1.2 out and borrowed 800,000. So you generally, when people have a huge amount of equity in the house, generally when we give them the scenarios and they see all the options both ways, they show their account, most times they come back to us, sell that house with all the equity, buy another home, and then pivot and use the equity in that one to buy a more tax effective investment property. But you're saying here about you maybe want to rent. That might be different. So there might be reasons where you hold that property, even though it's not the most tax effective way to do things, and rent because you might have great capital growth in that property.
Yeah, again, it goes back to that old saying, like, it's a very bespoke process, guys.
He uses the word bespoke
too much. But it is, because everybody is different and everyone has different goals, right? So, for example, in this scenario, you've got concern that you might miss out on property growth if you pull out. But if you're looking at this from a pure fiscal point of view, you would want to have a smaller owner-occupied home loan and then larger debt for a possible investment that you might purchase down the line, because that's tax deductible. But that might not be your long-term goal. So that's a discussion we'd have. And again, we'd run scenarios. We go, well, if you do this, this is option A, and this is what it would look like, and this is what your repayments would be. But this would be option B, and this is what this would look like. And then we talk about it together. We go through it, and then you go, okay, I understand. I've got enough information now to make an informed decision. And that's all you need. You need information to make that informed decision of what's right for you.
I think we'll move on to the next topic, which is rent vesting. And I think a few of these other questions are actually going to get covered in the rent vesting part. So we've covered off if I've got equity in property and how I'm going to use that equity to invest. And that is the most traditional form of investing that we've ever seen. But more commonly now, I would say the most common thing we're seeing in the last few years are people rent vesting. We've got so many clients that live in Brisbane, Melbourne, and Sydney. They want the lifestyle, they're living in units, and they're buying property in the regions. And they're doing that because they don't want to give up their lifestyle, but they want to be in the property market and they can't afford to buy where they are, or they don't want to buy where they are. They think they're going to get better capital growth somewhere else. So tell me, Joe, I've come to you. I'm living in the city. I'm having a great time, but I want to buy an investment property with my hard-earned savings. What's the difference if I'm rent investing?
So look, the difference here is that we don't have equity in an already established property to help secure this property. So we have to use cash or savings that we've got, unless of course we've got a guarantor option, which is something completely different that we would have a separate discussion about.
If anyone has a parental guarantee option, you want to investigate that before you rent vest.
Yeah, we'll talk about that. Call me. So let's just say, for example, you're looking at rent vesting. We've got to use a cash deposit. Now you might have $150,000 to go towards this prospective purchase. This is where it's really important to set yourself up for success from the start. So we're buying an investment. We know that investment debt is tax deductible, which is good. We want that. That's great. We've got a deposit here of 150,000. Now you might have told me, yes, we want to rent vest for the time being, Joe, but eventually when my income goes up, eventually I'm going to want to buy an owner occupied property that I'm going to live in. Right? No problem at all. So with that in mind, it might be more fortuitous for you to put toward a minimal deposit as possible towards the purchase of the investment that you're buying, and keeping that cash to one side to buy a prospective owner occupied in the future. So we would do those calculations. We'd have a look. We'd see what the lender's mortgage insurance is going to cost and the interest rate accordingly, and then make those decisions. The majority of lenders will only allow you to borrow up to 90% inclusive of that lender's mortgage insurance, other than Newcastle Permanent, but there are the majority of lenders. Yeah, ANZ as well. Thank you. So we would only be capped at that 90 anyway. But what I'm saying is you might want to keep that cash to one side to buy that owner occupied moving down the line, because again, we want that owner occupied debt to be as low as possible.
So let's say I've got this $150,000. Let's say I've got $250,000. You told me I need $150 not to have mortgage insurance.
Sure.
I don't like the look of these repayments here. I'm going to go interest only.
Yeah.
I don't want to spend $2,600 a month. So I want to I've got $250,000. Would I then borrow $380,000 to reduce my monthly repayments? Because that's what's actually important to me. Yeah.
So if cash flow is important to you, that's fine. We're talking interest only repayments here anyway. So my recommendation would be get the loan for $480,000, take the $100,000 that you've kept to one side and put it into an offset account. Because if you put it into an offset account and we're only paying interest only, it's going to reduce your monthly repayments as well. So it's going to give you that cash flow flexibility, whilst at the same time giving you access to that cash.
So I'm putting $100,000 into an offset account on my investment loan.
Yeah.
I'm paying interest only repayments on $380. So it's like I've got a $380 loan.
Correct.
Why would I do that rather than put it into the redraw account?
Because if you put it into the redraw account, you're reducing the actual limit of the loan. And remember, it goes back to that thing. It's all about tax deductible debt. So if reducing that tax deductible debt, it's not as advantageous to you. Also, it's not as easy for you to just draw upon it as if it were in an offset account. So you want that easy accessibility to it for you to then go and get that owner occupied down the line.
So there's a lot of questions here about offset accounts and whether they're worth it and whether you would have an offset account on an investment property. I feel like this is a perfect example of where you would have an offset on 100%. An investment property, because if I pay that loan down, then I've reduced my tax deductible debt. But if I put $100,000 in the offset account, it's like I'm paying interest on $380, but I have full access to those funds, and I can use it on anything else I want, but I still have $480 tax deductible against this house.
That's right. Yeah.
So if I used a parental guarantee, I'm just going off
On sequestering
to a
here.
different tangent.
Yeah.
If I buy this house for $600,000 and I use a parental guarantee, I'm going to be paying stamp duty because I'm not getting a first home buyer's grant because I'm not living in it. That's one downside. So I actually need $630,000 to buy this house. I could essentially have a loan of $630,000 because I'm using a parental guarantee to prop up the equity.
Yeah.
But I could stick that 150 in that same offset account.
100%. And remember, with a parental guarantee, you can borrow 100% plus costs. So you can borrow that 60 plus the stamp duty and legal fees, whatever else it is. But the reason you do that is you keep that cash to one side for when you buy that owner occupied, because you want that owner occupied debt to be as low as possible. That's the key.
The reason I asked that question is it made me think of a client that I had recently who bought a property. They had their deposit. They actually had quite a big deposit. They had 200,000 and they were going to buy a house exactly like this. I want to live in the city. I'm going to buy an investment property, but they had planned to buy an owner occupied property with their partner the following year. Yeah. And they came to me and said, well, I want to borrow an 80% loan. And we dug down a little bit more when we're talking about goals and we're talking about what the long-term objective is. And his mother was actually in the interview. And I mentioned this parental guarantee and how he could sit that in an offset account and then move that into the home loan. So what he did was, very similar scenario, borrowed 100% plus cost for the investment property, stuck his $200,000 in offset. So he's only paying interest on 480. So it's like you've borrowed 200 less. But at the time he and his partner bought an owner occupied property, they could just swoop that 200 out and put it straight into a tax effective environment, being their home loan. Obviously your parents have to be on board. Yeah. But if your parents are on board and you're rent vesting, it can make it a lot easier and a lot more tax effective as well. I think that is all of the live questions. While we just wrap up, I'm going to read some of these questions that came beforehand to see if we missed any. Please feel free to ask any questions that you do have while I just go through here, because I think that we've missed some of the ones that were people put in beforehand.
And there's no silly questions, so ask away.
Gillian has asked, how old is too old to get a mortgage?
Great question.
Have I already asked that one?
No, I don't believe so.
Sorry.
So, great question. I mean, look, when we're talking about investment debt, or indeed any debt when it comes to age, it's all about something called exit strategy. So it's how you're going to pay the home loan out once you reach that retirement age. So when it comes to investment, it's not so much of an issue, because for a majority of lenders, an acceptable exit strategy would be sell the investment, get rid of the residual debt. So, you know, I've done loans for people well into their 60s before buying investment debts because of that reason. So again, I would say reach out, let's run the scenario, let's find out what your goals are, and then we can see whether or not it's going to be feasible. Yeah.
And while you're saying reach out, I'm going to flick to the next slide. If I can do that. I'm technically challenged. It's not letting me do it.
Do you want me to? Yeah.
Please.
Oh, there it is.
Joe.
Yeah.
I'm going to put an email address up here, which is hello@spherehomeloans.com.au. If you do have any questions, or if you would like Joe to answer any of your scenarios, please send them in. I think it's a lot easier when we have a little bit more information. It doesn't cost anything. You don't have to, there's no commitment, but if you'd like any questions answered, please reach out to Joe at hello@spherehomeloans.com.au. But I will try to get to the rest of these. One of the questions here was, and I like this one, Stephanie, how do you resist the temptation to buy an investment property when I have no mortgage on my own home? I want to upgrade that home, but I also want to buy an investment property. So how to resist the temptation is hard, because I think there's a lot of good buyers in the market at the moment, because as you can see, the people who were investing at a rapid rate are definitely slowing down because they have to. The levers are being pulled.
Or offloading.
Yeah. So before I jumped on an investment property though, or upgrading my own home, which is your bigger goal, I would run the scenario. I would reach out, find out. I guess you don't know the answer until you know. So put all your details in and say, what can I do? If I did buy this investment property, could I still achieve this goal? And I think then it would answer those questions. If you've got all the information to make a decision, then you might not be tempted, or you might be very tempted and it might be a great investment. So
you might be able to do both.
You might be able to do both. Yeah. So I'd put the information out and find out. Colm asks, do you need to tell your bank if you're making your home loan an investment loan? And does that impact your fixed rate? Joe, what do you think about that?
Difficult question. So it all depends on what your activity is and what you're looking at doing. If you're in a fixed rate home loan, and you've switched it over to an owner occupied property, over to an investment property rather, and it's currently an owner occupied, it is up to you to inform the bank. The bank are not just going to automatically look at your bank statement, see there's rental income coming in and move it over. So that's up to your discretion to inform your lender that you've actually moved over to an investment property. And the same goes for variable. It's not just fixed. That would be across the board. So that would be up to you. They're not going to proactively look at you and go, well, this is an investment.
No. And I think where people get confused here, and this is a really common misconception, they want to have tax deductible debt. They want to move out and make it an investment property. Do they need to make it an investment loan? No, you don't. The accountant doesn't care what it's called. It doesn't care that the accountant doesn't care it says home loan. It's about purpose. So as soon as you leave that home, from the day you rent that property out, that's an investment loan from tax purposes, and you tell your accountant that that's a rental property. But whether you tell your bank or not has nothing to do with that. It's about purpose. And it wouldn't. So sometimes investment loans are a little bit higher, but you may not need to do anything to do with that loan until you buy your next property. So and I've got clients that have sort of built their portfolio up and bought a home loan, made that an investment, and then this stays a home loan. Then they get another home loan. So if they have two home loans at the same time, this is still tax deductible, and then they keep going like that. You don't have to go back and change everything if you don't want to, but a lot of people do want to change it to interest only.
Yeah.
And then you would change it to an investment loan at the time. Sorry, Kat, we live in our own home at the moment, but want to transition to RentVest next year because we want to access a better lifestyle. Good on you, Kat. What are all the things we have to do to consider from a numbers perspective to decide whether it's a financially smart decision? So I would say, Kat, to be able to answer that correctly, we would just need to understand all of your information. And we couldn't give you the advice on what to do, but what we can do is give you the scenario. So you give us your income, the property that you're living in now, how much you've got owing on it, and what, I guess, some of the proposals that you've got. That might be rebuying something else, it might be renting. Let us know how much you're considering for rent. And we will come back to you and say, this is what would happen scenario 1. This is how scenario 2 looks. And then you have, I guess, a lot more information when you're sitting down and thinking about what to do.
And what's your goals after that? It's not just about that period there. It's about what your goals are moving forward from that point. And I think another thing to note, which we sometimes get lost in when we're talking about numbers and finances, there's other things that need to play in here. There's the emotional side of it. Yes, financially, we want to make the smart decision, but we've also got to think about quality of life and the things that you want to achieve from that perspective. So consider that as well. It might not always be completely numbers driven, and we would help you make that decision with the scenarios, yes, but ultimately it'll be up to you.
Zoe's asked, and there's a few questions here that have been sort of outliers. They're not answered in the general scenario. So I'm going to answer a few of those now. Zoe's asked, what are the major drawbacks of purchasing a property through a family trust? Now, Zoe, if I was answering that question, I would say I'm probably not the person to ask. What I would say would be the person to answer that question is your tax accountant. They will give you all the information about pros and cons of buying in a trust. What I can say is, though, I get a lot of clients come to us and say, I want to buy in a trust. And by the time I send them back to their accountant, they come back to me and say, we've decided not to buy in a trust. Buying in a trust is a lot different now to how it used to be. The clients that have come back to me and said, I didn't realize I wouldn't have a capital gains exemption, or I'd have to pay land tax straight away. Or there's other things that people might say that would draw them away from buying in a trust. But if your accountant says, this is a great idea, this works for you personally, this is the reason you'd buy in a trust, from a lending perspective, we can do that. We just haven't had a huge calling for it with some of the changes that have been made. But I did have a client that did buy in a trust for a particular reason, and we placed their loan with the major bank. We got them a great rate. I don't think they could have an offset account with that product.
No, I mean, a lot of lenders don't enable you with a trust. I had the same issue.
Some don't go into mortgage insurance. Some of them limit to 80%, but we try to limit to 80% anyway. But the answer to your question is that the drawbacks would generally be that question is for your accountant. He'll tell you the downsides. But from a lending perspective, if you want to buy in a trust, we can do that. So one of the questions here is, I've got a house with 30,000 left on it. Do we sell or rent vest? Now, again, I think that's one that we're going to have to break down like Cats. I think we're going to have to work out that for you. But if I had 30,000 left on my mortgage, and I was going to think about changing that to an investment property, it would have to be a profound reason for me to want to hold that property to negate the tax implications and the money I could get out to put into my next property for, my own home. So sometimes there are those reasons, though.
Yeah, there might well be, you want to keep it for someone else to move in it later on the track, maybe children or something like that. But we'd run the scenario and we'd find out, the fiscal and emotional reasons behind your decision making, and then make a decision from there. Another really good question here that we've got is, what do you do when banks won't lend you any more money for investment property due to being at capacity on your borrowing power?
That is a good question.
That's a crafty
I
question.
answer this question daily at the moment.
Yeah, it's gotten quite hard, especially with these rate rises, become really difficult. So the first thing I would note there is get more than one opinion. And that's where a mortgage broker comes in, because let's just say, for example, you've just approached one bank and they've said, this is your maximum capacity. That might not necessarily be the case for all the banks across the board. I had a client not that long ago, it was a $200,000 difference from one bank to another. So it's really important that you're making sure that's the case across all the lenders and not just the one lender that you've looked at. If that is the case, unfortunately, there's only two ways to increase your borrowing capacity. One is to reduce your existing debt position, and two is to increase your income, which is not as easy as it sounds, obviously. So that's something that we would discuss. And there might be things like, you might have a personal loan or a credit card, which might boost up that. If we close that, it might boost up your borrowing capacity. But again, that'll be talking through that scenario and running through and go, okay, if you want to get from here to here, this is what I would need you to do. And we have that discussion all the time with clients. I had that discussion 3 times today. So we would have that discussion about, if you want to get to this point, this is what you need to do. And then away you go, and then come back 3, 6, 9, 12 months later.
And I think all of these questions about, especially about people that, are worried they're not set up correctly, or how do I do this and this, that is what your mortgage broker does. More, I've said it before, but more so than actually sitting down and comparing loans with you, it's working through these scenarios. Most of my time now is spent answering questions for the clients that I have. They come back to me and they're wanting to know different scenarios all the time about what can we do here, and we're breaking down those scenarios. That's part of what we do for you. The banks pay us to do your loan rather than paying their own bank staff. They pay us to do your loan, but that also allows us to act on your behalf. So we are your broker. Even though the banks are paying us, we're acting for free for you to give you all of these scenarios, not just when you're doing a loan, but all the way along the process. And we have clients for a very long time, and we see them buy their first house, buy their second house, build their portfolio, downsize their portfolio. And usually that relationship goes across a number of different banks in the time that we have them.
Yeah, absolutely. Like I said before, we don't really have any loyalty to any bank. It's all about what is most fortuitous for you. And if that means moving you, as long as it's in your best interest, then we will do that 100%.
A lot of the time people go to one bank because first home buyers, this bank has a really great first home buyer deal. They've got really low rates. They'll do 97% lending. This is really great. But by the time you're buying your first investment property, it's really different. We're looking at people that do great interest only facilities, people that take 80% of rents. So I feel like the banks, it's not just about the rate of the bank, but I guess what sort of market they're looking for and what's going to suit what you want at the stage of your life.
Yeah. I've just noticed one more question has popped up at the bottom there. Is it true that banks don't like to lend for 1-bedroom apartments? It's not true. There are banks that will do it. But there are certain restrictions sometimes put on that security. A big thing for a lot of banks is floor size. So if you have a minimum floor size requirement for a 1-bedroom apartment, say, I recently had a client literally last week, they're buying an off the plan property. It is a smaller floor size. It is a 1-bedroom, and a lot of lenders won't do it, but I found a place for it to go. So I would say in most cases, there's a lender for everyone and every security. So that would be a question. We'd run through the scenario, we'd look at it, and we would even put it to the lender before we'd even submitted the application, go, would you have comfort and appetite for this deal with the security, and get you that comfort? Because often with these, if you're buying them off the plan, you have to put a deposit down before you can even get a finance in place. So you want that security to know, yes, I can do that, and yes, they are going to accept that, and that's what would be provided to you at the time.
Yeah, I feel it's more studios than one bedroom.
Yeah.
The studios can get quite small, and then the banks might have, it might be size driven, but sometimes it's size and postcode driven.
Yeah.
So they might do a certain size, but as long as it's not in a certain postcode, or some will say, we will only do a certain amount in that particular building. So there's a few buildings in the city that have, a certain bank that we love for small units. They've capped out. They say, well, no, we've already got 20% of that building. We won't do any more. And then we're looking at other lenders. But I would not agree with the statement that banks don't like one bedroom apartments as a general rule.
Another question, is refinancing every 12 months too much? From Leonie. Great question, Leonie. Every 12 months, look, to be honest with you, if I'm looking at your lending and we're refinancing you every 12 months, it might be that we're not actually attempting to reprice you at your existing lender enough. We're not ensuring that the lender that you're with is giving you an adequate, interest rate relative to the competition around you. It's not something I would recommend, because also it's a pain. Like, refinancing is a pain.
I feel like if we're doing our job, we're recommending a bank, not just that has a good rate now, but that is open to our negotiations in 12 months' time. So I'm not putting somebody with a bank unless they felt really strongly about it. If they're asking for my opinion, I'm saying, well, this is a bank, this is the rate. This bank might be 0.01 less today, but I'm recommending this bank because even though they've got a good low rate, they're not the lowest. I know in 12 months' time, they're still going to be competitive. And I know if I take them an offer from another bank in 12 months' time, they're going to match it. So I don't want my clients refinancing every 12 months, even if it meant I get paid every 12 months. It's not good for you because you're having to do all this paperwork every 12 months. And I just don't feel like I'm giving you the best advice if I'm not putting you with someone that you're happy with longer term. But it's your choice.
We tend to recommend banks that have a history of repricing our customers and looking after existing customers.
I have one client. I've got one client that has a big fat loan that does refinance that nearly every 18 months. And they do that for rate, and they do not care. They do not have any loyalty. They do not want offset accounts. They've got one big investment loan and they just shop it. That is a very rare case. So there are people that do it, but I don't feel like that's an outlier.
Yeah, I think, again, it's a discussion we have. And if you feel passionately about it, obviously that's something we'd explore. But as a general rule, it's not something we'd recommend, I'd say.
Amazing. Well, look, I know that we haven't gotten through all of the questions, but we are looking at time being up. So I'm going to say, anyone who, if we haven't answered your question, or if you've got more information, you'd like a more detailed response, please reach out to hello@spherehomeloans.com.au. We're here to help. We do this every day and we love it. So thank you for joining us. And thank you, Joe, for all of your
worries. Thank you, guys.
Cheers.
Cheers.
And we'll see you soon.
Thank you.